Hi class, welcome to topic 3, which is the risk and return chapter in chapter 6. It's talking about what kind of returns we receive and how much risk we expect to be taking to get those returns. I've broken chapter 6 up into 7 videos, and I'll be giving you practice exercises to do. The first of the files I'm calling return measures. It actually starts off with a question: are all investors equally satisfied with risk? Are there people who are different? Are there people who are risk avoiders? Maybe there are people who love risk. Maybe there are people who are indifferent to risk neutral. So we'll talk about those. Then we're going to break down risk into 2 categories: systematic and unsystematic, which I will call market and business risk. And then we'll look at 3 measures of return. The last is holding period return, which we'll be using throughout the rest of the videos. File 2 is risk measures. We're going to look at variance, standard deviation, coefficient of variation, covariance between the returns of 2 stocks, correlation, and beta. File 3, we're going to download data and repeat those calculations. We're going to calculate return, variance, and standard deviation for Pfizer Company and using the Standard & Poor's 500 ETF as the index. In File 4, we're going to complete the measures by looking at the covariation between the index and Pfizer, correlation, and beta. All of this is coming from the download data from File 3. File 5, we're going to look at a regression analysis between the Pfizer stock and the index. It allows us to get a lot of information simultaneously. We'll be able to talk about how much return is coming from systematic risk, how much of the risk is systematic risk, how big is the beta significant, and a variable called alpha, and in Excel it's called intercept, but it's still the same variable. File 6 is the capitalist pricing model. We'll talk about that, and we've started talking about it in File 1. We'll completely talk about it in File 6. 7 is looking at, if I bought 2 stocks, what would be the portfolio returns, and how would I calculate the portfolio standard deviation. And well, that summarizes all the topics I'm going to have in risk and return, all related to Chapter 6.